Welcome everyone. My name is Paul Labonne and I will be sharing this seminar. So this is the last webinar of our ESCoE economic measurement series. And I'm very happy to have James Mitchell talking today. James is now at the Federal Reserve Bank of Cleveland, and James has done a lot of work on quantifying and communicating uncertainty. And today we will be talking about censored density forecasts. James will talk for about 45 minutes, and then we will have 15 minutes for questions and answers. So please, if you have any question, type it in the Q&A box and we will go through them at the end. And this seminar is also recorded and will be available on the ESCoE website. So James, if you want to start, please. Thank you.
Good morning, everyone. Well, I assume it's morning for most of us. And thanks very much, Paul. Hopefully everyone can see my slides here and hear me clearly. Please let me know, Paul or Mercy, if I've made a mess of things again. Okay, well, as you can see, today I'm going to be talking about censored density forecasts. And obviously this is part of the ESCoE economic measurement program of webinars. And so the focus of this paper is very much about measuring uncertainty, but also, as I'll get on to talk about, thinking about perhaps when we cannot measure uncertainty and what we should do about that. This is joint work with Martin Wheel, now at King's College London, but of course actually on the Monetary Policy Committee at the Bank of England for some of the period of analysis in this paper. And as ever, the standard disclaimer applies that these views are our own and not necessarily those of the Federal Reserve Bank of Cleveland or the Federal Reserve System. Okay, I'll start by way of motivation with a couple of pictures. These are histogram. This is a histogram plot of the Monetary Policy Committee at the Bank of England's historical forecast errors around their modal forecast for their 2-year ahead GDP growth forecasts. And the error is defined here as outturn minus forecast. So one feature perhaps you notice straight away when looking at this histogram of forecast errors, I should say this is on a sample stemming from the operational independence of the Bank of England in 1997 through to just before the start of the pandemic period. I'll get on in a minute talking more about what effects the pandemic has had, of course. And so say, perhaps the one feature that, feature that stands out, hits you sort of straight away when looking at this histogram is the potential sort of skewed nature of the histogram. Namely, we're seeing a lot of negative forecast errors. And given the way we've defined the errors here, that's of course saying that the Monetary Policy Committees had a tendency to be optimistic about growth prospects relative to what subsequently happens. And importantly, as I say, this sample does extend through to sort of the end of 2019. We see a bunch of quite large negative errors. These errors were the errors made in the period of the global financial crisis. So in other words, this graph's just reminding us that, the unexpected happens, shocks happen. But of course, as we see when we extend the sample through 2020, through the pandemic period, we see some even larger, particularly a notably large forecast error in 2020 Q2, when of course the lockdowns hit the world, hit the UK economy specifically here, and we see that large negative forecast error. So of course, the Bank of England, along with many other along with all, one would hope, policymakers and forecasters, is well aware that these uncertainties can happen. And so, indeed, it's quite common practice, particularly at central banks and in many professional organizations, where there's some subjective component to the production of the forecast. It's quite common for assessments of future uncertainties to be informed at least in part by monitoring historical forecast errors of the like I've just shown you for the Monetary Policy Committee at the Bank of England. Indeed, as Rice, Schneider and Tulip review, this is general practice across a bunch of central banks and indeed other organisations too. Quite how the institutions then proceed in terms of forming their own forecasts does vary. As of course is well known, and as I'll talk about more in a minute, the Monetary Policy Committee at the Bank of England famously uses a two-piece normal density to parameterize its forecast uncertainty. The Federal Reserve Board, by contrast, makes an underlying Gaussianity assumption, but in fact emphasizes a 70% central interval forecast. So, this is great. These, organizations like the MPC and the board are quantifying and communicating forecast uncertainty, but in the light of the shocks that hit the economy, the global financial crisis, and of course the pandemic more recently, what, if anything, should organizations like the MPC and the FRB be doing in the face of these extreme errors or outliers, particularly when forming their probabilistic forecasts on the basis, at least in part, on inspection of historical forecast errors? I say it's, well known, of course, that the Bank of England, in its Monetary Policy Committee, communicates its forecast uncertainties via the two-piece normal fan chart, as I touched on earlier. Perhaps a feature of its fan chart that's less well known, indeed this was the original motivation for this piece of work, is when Martin and I noted that the manner in which the Monetary Policy Committee communicates its fan charts is such that, as we can see here, the MPC visualize and communicate so-called best critical region or shortest interval 30% bands based on that underlying two-piece normal assumption. So the darkest green shade here denotes 30% of expected outcomes, and the sort of middling green shade is the other 30% until you get to the lighter green shading on the outer part of the density forecast. So of course, 30 plus 30 plus 30 equals 90. So there's a missing 10% there. So this feature of the MPC's fan chart seems to have been, largely overlooked, including some of my previous work when I was evaluating the MPC's fan charts. But it's this feature which we are going to very much pick up on in this paper, and we're going to perhaps think further about what, in effect, what the MPC are doing, whether deliberately or otherwise, is censoring their forecast uncertainty, just as any forecaster, when producing and publishing an interval forecast, is also censoring to some extent what's going on in those outlying observations. So it's in fact, just by way of historical background, in 2010, in their May inflation report, this is the first time that the MPC noted explicitly that 10% of the time, the unexpected can happen. It's also important to note that, as I said, these bands, as produced here, are not necessarily, given that they are shortest interval or best critical region intervals, given that the underlying density used by the bank, the two-piece normal, need not be symmetric, these best critical region intervals need not lie between, for example, the 5 and 95% quantiles. In other words, it's perfectly possible for the MPC to be suggesting that there's a higher chance of the unknown unknowns happening in the left tail than the right tail. As I say, that's a feature of, to repeat, of two things: the fact that these are shortest interval forecasts, and secondly, that the underlying density forecast need not be symmetric. So say in our language, the MPC is producing a censored density forecast. And as I touched on, we can also reinterpret the confidence intervals produced by the board, the ECB, the CBO, and other organizations, often publishing 68, 70% confidence intervals. Again, you know, that's great. They're communicating uncertainty around their central forecast, but the censoring, ignoring certainly the magnitude, but not the frequency of what happens in that outer region of the density outside the interval forecast itself. So the objective we set ourselves in this paper, in the light of this practice, or certainly in the light of how we are reinterpreting what these central banks are doing, is to think more about how, if you know, reinterpreting what the banks are doing as producing censored density forecast, well, how, in fact, you know, econometrically, statistically, how should they be producing those censored density forecasts on the basis of the historical forecast errors? And indeed, how should they ex post be evaluating the quality of the censored density forecasts? So, you know, to be clear, a censored density forecast is quantifying forecast risks. Note I'm being deliberately kind of Knightian in making the distinction between known and unknown probabilities here, between risk and uncertainty. This, you know, in the light of that, the censored density forecast is quantifying forecast risk in the middle region of the density. So the MPC in that middle region of the density, in that middle 90% region of the density, the two-piece normal applies. But outside that, anything goes. They're not parameterizing, they're not offering any view probabilistically on what may happen in those 10% tails, or in the case of the board, in the 30% tails. Beyond the fact that one would hope, as we'll get onto when thinking about the evaluation of censored density forecasts, that 10% of the time, the unexpected should happen, and we should observe an outturn in the censored region of the density. You know, it's also of note that this concept, which I guess we're trying to advertise here, of a censored density forecast, you know, it accords with ideas in the work of Laura Veldkamp and co-authors, whereby economic agents are assumed to know far more, or assumed to know about the probabilities of everyday events, that is, events in the central region of the density, but they are unaware of, unwilling, unable to quantify, you know, tail black swan events, given that by construction, by definition, these are events that are rarely observed. So this paper kind of takes has two parts to it in the light of this. Firstly, about how should we produce censored density forecast. Secondly, how should we evaluate them? So let me talk first about the production of censored density forecasts. And remember, what we're going to be focusing on is fitting a parametric density function to the data, in our case to the historical forecast error data. But importantly, we assume that that density only applies to a region of the density as defined by the best critical regions, defining the region, you know, the percentage of coverage that you want the censored density forecast to have. And outside, you know, in that censored region, anything goes. We're not parameterizing those outlying probabilities. So that's the sort of question we set ourselves, and we are going to try to estimate the parameters of these censored density forecasts, importantly, allowing for the fact that that uncensored region of the density may well have fat tails, and it may well be skewed. And as many of us know, both of these issues, fat tails and skewness, particularly in the light of the pandemic, but also in the aftermath of the global financial crisis, have been seen as popular and effective ways of modeling and forecasting macroeconomic data. So in the, we are very much going to be drawing on that literature, drawing on those insights by allowing for these features when fitting our censored density forecasts. But in the light of the fact that we're allowing for these features of fat tails and skewness, but in the light of the censoring, we may well expect to find that the evidence for fat tails and skewness is perhaps influenced by how we handle these extreme events. And to give you a kind of a heads up, we do indeed find that the evidence for fat tails and skewness that many scholars and central bankers and others have found, both in the aftermath of the global financial crisis and in the booming literature we've seen in the aftermath of the pandemic, a lot of this evidence for fat tails and skewness disappears, perhaps unsurprisingly, but we show this more formally via our censored density forecasts. That evidence for fat tails and skewness disappears when you censor the extremes of the observation. In other words, to pick up on some language of Laura Veldkamp again, what's happening in the tails kind of can wag the entire central bit of the density. Okay, well, let me first just, as I say, run through the, I'll do this quite briefly, set out the sort of general class of distributions which we entertain in the uncensored region of the density. I mean, in principle, this density could be any flexible or any density of your choosing. We are asking you to parameterize it though. So in the paper, we in fact just consider a general class of skewed distributions, or 5-parameter skewed distributions, reflecting work also of Rubio and Steele, which many of you may know about. And these are, in other words, very flexible distributions, in fact, more flexible than the 2-piece normal used by the Monetary Policy Committee at the Bank of England. But like a 2-piece normal, they involve splicing together 2 distributions, which may have different scale and may have different shape too. In the interests of sort of time today, I'll focus on a sort of a leading but specific density within this general family, namely the 2-piece T of Fernandez and Steele. Well, here is the density. I'm not going to talk through every, this will be familiar to many of you, but as I say, just like the 2-piece normal, the 2-piece T joins together 2 T densities around the mode, the mu. But of course, unlike the 2-piece normal, via the new parameter, the degrees of freedom parameter, we're allowing for fat tails. But importantly, like the 2-piece normal, we're allowing for skewness when this gamma parameter deviates from unity. So this is a pretty flexible density. So in the paper, we in fact entertain some even more flexible densities than this, but actually find that 2-piece T does a pretty good job of fitting historical forecast error data of the type I just showed you at the beginning of the presentation. So say, given this 2-piece T density, of course, we can write down the likelihood and bang, press go on the on MATLAB, whatever your preferred software package is, and we can estimate the parameters of the distribution. And that's exactly what we now do so for those histograms, for that histogram of forecast errors I showed you previously. As I say, those were the pre-pandemic histograms. Unsurprisingly, we're interested now what effect the pandemic has had on measurement of macroeconomic uncertainty. So the bottom panel adds in the last couple of years worth of data, of forecast error data, historical forecast error data from the Monetary Policy Committee, including this large negative error observed in 2020 Q2. So there, there's quite a lot going on in these graphs, and so I won't bore you by going through every sort of parameter estimate that you can see detailed here. So we just try and draw out a couple of main features, observations that certainly Martin and I had when looking at these graphs, so we can then think about their implications. Firstly, in both pre and post-pandemic, it's striking how the two-piece T seems to do a better job, or does do a better job, at fitting not just the tails, which is often seen as being more robust to outliers, is often a perceived attraction of a T distribution. But you also see that the counterpart of that is the two-piece T is able to do a better job of fitting the higher bins towards the center of the distribution. So in short, the two-piece T seems to be doing a better job than the two-piece normal distribution. But it's of note that whether you look at the two-piece T or normal, there's some evidence of skew. This gamma parameter of left skew is greater than unity. It's also noteworthy how that skew parameter, the degree of skew, is much higher for the two-piece normal than the two-piece T. And indeed, that skew is particularly elevated for the two-piece normal post-pandemic. So in other words, effectively what happens as you move from, when looking at the two-piece T, from pre-pandemic to post-pandemic samples of forecast error data is, post-pandemic, the two-piece normal sees this minus 20% error and picks it up via, accommodates that, tries to fit that via jacking up the left skew. So you see, this appreciable increase in that gamma parameter from 2 to over 3. It's also of note, I haven't shown it here in the interest of not cluttering things even further. If you did entertain a regular one-piece Gaussian distribution, unsurprisingly, what one sees, obviously that Gaussian distribution, one-piece Gaussian, of course, by definition, is unable to pick up any skew. So you see a lot higher uncertainty when you just fit a regular Gaussian distribution. But of course, post-pandemic, you see that sigma parameter in the regular Gaussian distribution blow up even further as it tries to fit this outlier observation here. So let's just remember, keep that in mind, that this feature of what happens when you fit a regular Gaussian distribution to data that are contaminated by outliers. And of course, this is a feature that's been much discussed in the burgeoning literature modeling in the aftermath of the pandemic. Okay, just to provide an international perspective here. In the graphs here, we've repeated the exercise on the MPC's GDP growth errors at the 2-year ahead by looking at the Green Book, Teal Book forecasts of GDP, now 1 year ahead, slightly longer sample, 1 year ahead. Due to the embargo in those data, the sample actually ends here in 2015. So in fact, all the data are pre-pandemic. Just to provide an illustration of what we suspect will happen when in due course the data are made publicly available. You see a similar thing when you look at the US SPF, for example. Unsurprisingly, we do expect to see in due course in that second quarter of 2020 a large negative forecast error associated with the Green Book forecast, Teal Book forecast, just like we saw in the UK sample. So in panel B here, we've added in a simulated minus 20 percent error observation and just appended that to our sample, just to begin to simulate what the effects of the pandemic are going to be on the Green Book, Teal Book forecast errors when in due course they become available. Okay, well, looking at the top panel, straight away you're kind of hit by the fact that unlike in the UK, on this US sample, the forecast errors are much more symmetric. We're allowing for asymmetries, but the two-piece T and the two-piece normal are saying, doesn't do much for you, as indeed looking at the histogram might lead you to believe. So that gamma parameter is coming in, very close to 1. However, you do see some evidence that the fat-tailedness and the ability to put a higher probability in the central region of the density offered by a T density does pay off. In other words, this degrees of freedom parameter is pretty low. So that again is suggesting that there is some gain to moving beyond Gaussianity. As I said, it's of note that when the board produce their interval forecast, 70% interval forecasts around their point forecast, they do so on the basis of a Gaussian distribution. In fact, a Gaussian distribution fitted to a rolling sample over the last 20 years of data. So you can begin to see, and as time permits, may get on to talking more about this later, that use of a rolling sample is indeed a way of implicitly or explicitly censoring itself. But of course, a rolling 20-year sample is not for 20 years going to ignore this minus 20% observation we see in the simulated panel at the bottom. Okay, so that just gave us an impression of what the data, are like, the forecast error data are like, and what sort of impression of forecast uncertainty, forecast risk, one would get if one fitted a more flexible class of densities to those data. But of course, as advertised with a censored density forecast, which Martin and I are proposing, we do not want to make any distributional assumptions, as we just have when we fitted those two-piece T and two-piece normal densities. We do not want to make any distributional assumptions about observations in the tails of the density, but importantly, we want the data to tell us what those tails are. Remember, our focus here is going to be measuring, defining the uncensored region as a shortest interval region. I repeat, it's not going to be necessarily the distance for, if you're interested in a 90% censored density, 90% coverage on your censored density forecast, those intervals need not be between the 5th and the 95th quantiles. So here we set out a more, a general way of representing our view that we, within, when forecasting the random variable y, within the bounds, the censoring bounds that define the 90 or 70% interval. Let's denote those bounds, censoring bounds, by YL and YU, lower and upper. Within that region, your preferred PDF density function applies. So remember earlier we were assuming L was this two-piece T density, but I repeat, it could be any parametric density of your choosing. But outside of this region, all we are willing to assume is that there is a chance, we're not willing to parameterize the probabilities in the tails. I mean, here we call this likelihood A. You may guess a slightly different likelihood function is to follow. But in likelihood A, what we are assuming is that within the bounds, the two-piece T applies. Outside the bounds, the forecaster simply says there's a alpha percent, there's a percent chance of Y falling below YL, and there's a chance that Y falls above YU, and the sum of these two is the alpha percent, is the 10%. But again, under a symmetry of the density in the central region here, the forecaster may not be wanting to assume that there's a 5% chance of this happening and there's a 5% chance of this happening. Asymmetries are possible. But as I get on to summarize in a second, but as many of you may be able to see, in fact, far more quickly than at least I could see when we first sort of wrote down this likelihood function and set about estimating it, we quickly discovered that estimation was quite problematic. In fact, it took us a while to get our heads around this, but you can begin to see why estimation is problematic. Remember, we had the 4 parameters in L. I've now introduced 2 extra parameters I want to estimate, YU and YL. And I want to estimate YU and YL at the same time as I estimate the parameters, the 4 parameters in the PDF L. So in other words, the best critical region, the shortest interval, is contingent on the parameters estimated in the likelihood function L. So as perhaps as many of you could see, perhaps more quickly than at least I could see, this endogenous treatment of the thresholds, of the censoring thresholds, makes estimation problematic. So I did want to just quickly contrast this likelihood function A with an alternative assumption that the forecaster may prefer. As I say, under likelihood A, the forecaster needed to take a view as to what the chance of the unexpected happening in the left tail was and what the chance of the unexpected happening in the right tail was. If the forecaster simply prefers to say that there's a 10% chance of the unexpected happening, or a 30% chance of the unexpected happening, if you're at the Federal Reserve Board, they can do so by specifying a function of this type. Whereas you can see now we're completely agnostic as to whether observations are going to be above or below the upper and lower bounds here. As we sort of explore in the paper via a lot of Monte Carlo, we do in fact find that estimation of likelihood B, because it's a little bit more flexible in small samples, is a little bit of a tougher ask for the data to be able to discriminate between than likelihood A. Okay, so as I say, just flipping back to remind us of the scene. So the problem we're setting ourselves is to estimate the parameters, the 4 parameters for the 2-piece T in the PDF L, and at the simultaneously, endogenously, estimate YL and YU too. So you might think a straightforward way of going about doing so is simply to maximize that likelihood, subject to a couple of constraints. Firstly, the constraint that the probability of falling in the uncensored region is what you want it to be. Here I'll set it out as mimicking the MPC as a 90% chance that the outturn falls in that uncensored region of the density. But obviously that could be 70% for the board. But second constraint is the constraint, of course, that defines a best critical region, a shortest interval, namely that the PDF at YU equals the PDF at YL. Well, if you write down this constrained likelihood function, go about estimating it, you quickly find that some problems can arise. And in fact, for those of you any of you familiar with the estimation of mixture densities, where you've got heterogeneous variances on the mixture components, this will be a familiar problem. But the issue is that because we've got endogenous thresholds, it's possible that the variance effectively on one of the components can shrink to 0, and so the likelihood function becomes unbounded. So we illustrate here just an example of how this can happen, namely if it's perfectly possible that effectively the variance sigma, standard deviation, of the dense PDF F effectively shrinks. So this term, of course, tends off to infinity. But unlike in a sort of an uncensored estimation problem, because I've sort of constrained these constraints to be at sort of 5% and 5%, as it were, you get no penalty for shrinking this variance towards 0. So in other words, you've got an unboundedness to the likelihood function here. And so obviously this fits with the more, in short, the regularity conditions needed for sort of the asymptotic normality of maximum likelihood estimators are violated when the support of the density, as it does here, depends on its parameters. So in the light of this problem, we had to search out a solution, and we therefore propose and evaluate via Monte Carlo fixed point estimator. And the sort of, I'll just sketch sort of the logic of the estimator rather than provide you with any more details. The logic of the estimator is quite simple, namely that for fixed sensor points, that is, if I did know what YL and YU are, and conditioned on that in estimation, as long as all the uncensored observations are genuinely from the specified density, I would get consistent estimates of the parameters of that uncensored PDF F. So in the light of that truism, we propose a two-step estimator in finite samples. Namely, you start off with some candidate thresholds, YL and YU, maximize your likelihoods, you treat them as known. So I do get consistent estimates beta of the, so beta is now a vector comprising the parameters in my PDF. So I go off and estimate, get consistent estimates of beta. Then at a second step, compute the shortest interval given that assumed PDF. But of course, now I iterate between steps 1 and 2 until I minimize this term here. And in short, you know, we found in sort of an extensive set of Monte Carlo in the paper that this fixed point estimator works well, doesn't suffer from the unboundedness problem that one otherwise confronts with endogenous censoring of the sort we've got here. In smaller samples, you know, perhaps unsurprisingly, want a little bit more care does need to be exercised. The standard errors of the parameter estimates can be a bit larger, perhaps unsurprisingly, and there is a risk, as those of you will know when fitting uncensored, sort of regular skewed densities will know, there is a risk of getting divergent estimates for the skew parameter. Often what can happen is that the standard deviation of the density can kind of head down to 0, and you compensate for that by having a divergent estimate for skew. So given a tendency for that to happen in smaller samples, one can, of course, whether being more frequentist or Bayesian about it, impose a sort of a penalty on the estimator, you know, sort of encouraging the estimator or penalizing the estimator as it moves away from symmetry. And we found, again, in the Monte Carlo, that this penalized estimator in the smaller samples can be quite effective. And as I said earlier, if the forecaster is willing to take a view about what the probability of the unknown and unknowns happening, you know, is able to take a view as to what the chance of them happening in the left tail versus the right tail is, namely likelihood A, we do find that that pays off relative to the more agnostic likelihood function B, where all the forecaster assumes is that there's a 10%, whatever percent chance of the unexpected happening.
James, just to let you know, there is 10 to 15 minutes left.
Yeah, that's perfect. Thanks, Paul. Okay, so there's the, you know, I've now introduced you to the fixed point estimator that will let us now estimate the censored density forecasts, given a choice of alpha, 10% for the MPC, 30% for the board. So unsurprising to, you know, to illustrate the use of this censored estimator, fixed point estimator, I'm going to revisit the forecast error data, the historical forecast data I showed you earlier, but now, of course, fit censored rather than uncensored densities to that same forecast error data. Again, I'll make a distinction between pre-pandemic and post-pandemic observations, and as before, there's a lot going on, so let me again try and just sort of draw out some of the sort of key takeaways, implications of fitting a censored versus an uncensored density. Well, looking at the UK, obviously, as we are first, you know, perhaps it's striking straight off that the, remember we found when fitting an uncensored two-piece normal that the skew parameters became pretty large, you know, to fit even pre-pandemic, the shocks we saw in around the time of the global financial crisis. Unsurprisingly, when you censor those observations, you see much less evidence for skew than when you do not censor. And in particular, you don't see the skewness parameter blow up to the degree it did previously, even when you allow for the pandemic outliers. And also, you see that again, the T, the skewed T, the two-piece T, is paying off, and indeed, it's pretty robust to the pandemic. You'll notice how the parameters both for the standard deviation and the skew, are pretty similar both pre and post pandemic. Again, let's say suggesting, implying that the two-piece T, when censored, is offering a fair degree of robustness to the sorts of unknown unknowns, to the unexpected shocks that do hit the economy. You'll also note, of course, how there is still some left skew. In other words, and you can see that visually, borne out visually here too. So that left skew shows up as, this is fitting, I'm fitting likelihood A here, if you can remember, likelihood A. So the fact that we've got left skew is implying that there is a higher probability of an unexpected shock happening in the left tail than the right tail. In other words, the MPC tends to be surprised on the downside as far as growth is concerned, rather than on the upside. Flipping to the board's GDP errors, again fitting the censored densities. Well, what you notice straight away is that the evidence for fat tails that we saw when fitting the uncensored density disappears. In other words, the normality assumption of the board when computing its 70% intervals around its point forecast seems to be supported when one does formally fit a censored rather than uncensored density to the forecast error data. I repeat, if you did just fit a regular Gaussian uncensored density and then compute the censoring bounds, given that that underlying one-piece Gaussian density, you get a huge variance estimate and really wide bands, censoring bands. So in other words, remember the logic of fitting, even if these censored densities end up looking pretty Gaussian, or certainly more Gaussian than they did previously, because we're not making any distributional assumption about what happens in the tails, we can end up getting quite a different variance estimate to the uncensored density, and as a result get quite different widths of between, the length between YL and YU can be quite different to that than if we did fit a Gaussian density, as in practice the board do. So in other words, summing up, it matters, whether we censor or not. The parameter estimates of the, if we're going to fit a density to historical forecast errors to try and quantify forecast uncertainty, as many central banks and professional forecasters do, then it does matter if and how you pay attention to these outlying observations. What's happening in the tails does wag the whole density, as I mentioned earlier, when anticipating, there's some work of Laura Veldkamp and co-authors. There's less evidence for skew in the UK when we censor, and there's less evidence of fat tails in the US when we censor. And as we'll also show you very quickly in a minute, as I try and draw things to a close, censoring importantly also delivers, perhaps again unsurprisingly in the light of what I've been saying, censoring delivers forecast error densities which exhibit far fewer temporal instabilities than if we did simply fit an uncensored Gaussian density. So in other words, a lot of the temporal variation that in a lot of models, stochastic volatility type models that we might try and pick up, they disappear the moment we censor the tail observations. Okay, what I'll quickly run through now is the second part of the paper. As I say, focused on how to produce censored density forecasts, having hopefully given you some motivation for why the production of censored density forecasts might be interesting. But of course, having produced a forecast, it's always important to be regularly evaluating the censored, or the forecast, in this case, a censored density forecast. So in the second part of the paper, we propose some calibration tests for censored density forecasts. And let me just talk you through the intuition for those tests rather than get into any great detail. But echoing the sorts of tests deployed on uncensored densities, we're going to be looking at the probability integral transforms, so echoing the work of Dawid, well, back in the day, Rosenblatt, Dawid, and the Diebold et al. more recently. Recall for a correctly calibrated uncensored density forecast, we require these pits to be uniform on 0, 1. But of course, the point of departure with a censored density forecast is that these tail probabilities simply can't be computed because as either forecaster am just unwilling to quantify the tail bits of the density. So unsurprisingly, what we get towards is a kind of two parts to a calibration test for censored density forecasts. Firstly, if an outturn does fall in the uncensored region, namely between YL and YU, then I should expect it to fall in that uncensored region in a uniform manner. However, there is a 10% chance, or for the board, a 30% chance that the unexpected happens, and I get an outturn in the tail. I don't know how much it's in the tail. I just know it's in the tail, and of course, we can then think of a kind of a Christopherson type sort of hit coverage rate test, namely that, you know, if I have specified a nominal 90% censored density forecast 10% of the time, I should get those observations, outturns in the extreme tail. So we do develop a test, a joint test of these two components. We do so generalizing some work of the moment-based test of Knuppel. But we also note how Knuppel's test, as is done in Rossi and Sekoposian's paper, can be, you know, well, the Knuppel test can be reinterpreted within the framework of Rossi and Sekoposian, which perhaps lends extra generality. I note how, you know, like both of these tests, our test is therefore going to be robust to serial correlation in the pits, appropriate when evaluating multi-step ahead density forecast. So we're defining the pits in the usual way, but importantly, as a producer of a censored density forecast, I'm also going to be defining pits thresholds based on YL and YU, which either forecaster know these values as part of producing my censored density forecast. And so, as I said, within, you know, I expect uniformity of the pits when between these censoring bands, but outside of those bands, I do not. So given I now expect uniformity of the pits, not on 0, 1, but between ZL and ZU, I can kind of renormalize the pits accordingly, standardize them, and now test for correct calibration in the manner of Knuppel. So we can define a four-moment test along the lines of Knuppel. So this would be testing the first component of calibration for a censored density forecast. Of course, we need to augment that with a coverage rate type condition. Well, that we can do kind of along the lines of Christopherson by defining a proportion of, you know, by looking at the proportion of times the outturn does fall in the tail bit of the density. Define a new test statistic, which is independent of the former test statistics, the moment-based, the tests of calibration in the uncensored region, and define an overall test of calibration of the censored density forecast. And again, in Monte Carlo, we find this test does a pretty good job, both of discriminating calibration failures in the uncensored region of the density, and if you get the coverage rate incorrect. Okay, in the couple of minutes that remain to me, let me just now run through. I'll say so. I've set out to you. Hopefully, you're now familiar with the concept of what a censored density forecast is and how one might produce and evaluate censored density forecasts. You know, the final step in the paper is just to illustrate and evaluate, as if in real time, what these censored density forecasts might look like. So, you know, as is common in this sort of literature, we take the real-time databases for GDP and compute censored density forecasts, two-piece T, two-piece normal, T and normal, and compare them with the sort of the benchmark Gaussian density forecast used at both the board and at the Bank of England, and indeed in the case of the MPC, we can compare our censored density forecasts based on the data with the MPC's judgment augmented fan chart forecasts. I should say things like data revisions and how we define the outturn have a big effect. There's more on that in the paper, and indeed the formal evaluation tests are in the paper also. Let me just, as I try and draw things to a close now and leave a bit of time for discussion, let me just focus on visual examination of what these densities look like. I repeat, what we're doing is recursively computing the censored density. Oh dear, I've gone on to the wrong slide. Recursively computing these censored densities. So what I'm showing you here is recursively computed censored densities from the two-piece T in the blue line, comparing them with the MPC's own density forecast. So what we've done here is simply taken the parameters that the MPC of the MPC Fan Chart as published on the Bank of England website, and from those extracted the 90% best critical region. And alongside that, the red line compares the censored two-piece T and MPC forecast censoring bounds, 90% censoring bounds, with those if you did just fit a rolling one-piece Gaussian density to the historical forecast error. And the black line finally shows you the subsequent outturn. So again, there's a lot going on here, and too much for me to draw out in the little time that's remaining. So let me just focus on a couple of things. Firstly, you see in the, focus on the two big shocks, the global financial crisis and of course the pandemic. Looking at the global financial crisis in the period after the global financial crisis first, you can see that unsurprisingly, it takes some time for the database, it needs to wait 2 years. Of course, the 2-year head forecast to realize that the global financial crisis has happened and for it to update its assessment of risk, defined here as the width between YL and YU. And it's interesting how the database estimate puts all of that increase in risk it characterizes that by a lower estimate of YL. So there are indeed, it's clearly, so symmetries, downside risks are clearly coming to the fore in the aftermath of the global financial crisis. Interestingly and encouragingly, you see the MPC picked up the lower downside risks more quickly than the database method. And you also see that the regular sort of Gaussian density kind of overestimates the degree of uncertainty. And indeed, as we look finally at the period after the period in the immediate aftermath of the pandemic shock, the two-piece T, the censored two-piece T, as we might hope, this is what is an encouraging feature we feel, its estimate of uncertainty remains pretty temporally stable, even in the face of that outlying extreme negative forecast error. By contrast, of course, a rolling Gaussian estimate of the variance blows up the moment it sees that large negative shock. So in other words, the censored two-piece T is far more robust to these temporal, to outliers than a regular Gaussian uncensored density would be.
James, if you can conclude in a minute, please.
Sure, yeah, just got a couple, let me just, that's fine. Great. In a sense, similar things happen with the US sample, although of course this sample doesn't, for the reason because of the embargo, it doesn't yet cover the interesting period of the pandemic. So let me just sort of say again, it's kind of you can see that the estimate of the width of the bounds from the Gaussian density, the rolling Gaussian density, is larger and indeed more variable over time than those from the censored two-piece T. So again, telling us that this censored density offers a degree of robustness to temporal instabilities not offered by a rolling Gaussian density, also offers a tighter, and indeed, this is shown in the paper via the sort of more formal evaluation tests, offers a tighter and a higher scoring measure of forecast performance than this sort of benchmark rolling Gaussian density. Okay, but these couple of graphs that follow, I won't spend any time on, are simply just are showing us the parameters which were characterized by the censoring bounds shown in these earlier graphs. And again, the only real thing to draw out again here, perhaps I'll draw, in the interest of time, I'll draw out now, is how the, if you do just simply fit a rolling one-piece Gaussian density to historical forecast error, the moment you see the pandemic, your estimate of the variance unsurprisingly blows up. But the censored two-piece T, as we might hope, its estimate of uncertainty does not blow up. And as I said, for the US, again, we see that far more temporal stability in the estimate of the uncertainty parameter when censoring than if you do not censor. So there we are. So this paper's, is perhaps proposing, trying to propose the wider use of censored density forecast, noting that the MPC certainly already produces a censored density forecast, even if in production and evaluation that feature of its forecast has hitherto been overlooked. But we also might reinterpret the sorts of interval forecasts produced more widely as a form of censored density forecast. And we think that conceptually the idea of a censored density forecast may offer a forecaster, a policymaker, some attractive features that, you're quantifying the kind of known unknowns, but you are saying there's a 10%, a 20%, a 30% chance. Importantly, you, the forecaster, the policymaker, can choose that. Indeed, perhaps that might vary over time, but you can take a view as to how often you think the unknown unknowns might happen. You can accordingly censor your forecast, and therefore you are not required to take a probabilistic view as to what happens in those extreme tails. And so if you do sort of buy into the idea that censored density forecasts are a useful concept, well, in this paper we set out tools both for the production and evaluation of these density forecasts, which again, have the feature that they acknowledge that outer observations may be drawn from a different but unknown distribution to observations in the inner part of the distribution. And importantly, in practice, this censoring matters. Perhaps unsurprisingly, it delivers error densities that are kind of look more Gaussian and that exhibit fewer temporal variations than if you do not censor. Well, let me stop there because I know Martin's also on this call, so look forward to any questions that you may have. Thank you. Thanks, Paul.
Thank you very much, James. So if you have any questions, please ask your question in the Q&A box and we will go through them. So first we have a question from Gary Coop. So Gary, I think you can unmute yourself now and ask your question. Thank you.
Thank you. James, very good talk. It seems that you found a very nice way of modeling these censored densities. But I'm always thinking of alternative ways of doing things. I mean, a simpler thing to do is model the uncensored density and then censor afterwards. Now, the problem with doing that, as you've illustrated, is this sort of tail wagging the density, I think you call it that. Yeah, for not doing it that way. Would that happen with non-parametric approaches like regression trees? I suspect that they might have the property where you would not get this problem. And so I'm just sort of asking, do you think that's probably right? And if so, would that be an alternative to what you're doing?
Yeah, great question. And in short, I think you're probably right. I think this would be a great thing to explore. I note that that many of the more parametric, some of them become sort of semi-parametric models that we've seen in the, particularly in the aftermath of the pandemic. So namely a sort of, let's think of a, VAR model with stochastic volatility. Obviously, as we know, people like Todd Clark and others have been adding in sort of outlier processes to these sorts of models to pick up the transitory increase in volatility in the aftermath of the crisis. So those sorts of models do take a view as, in a sense, essentially take, in our language, take a view on alpha, namely what is the chance of an outlier happening. But of course, they parameterize the outlier process, albeit, you know, hopefully in quite a loose way, by some sort of uniform distribution or something. Of course, our point of departure is that we like them, would take a view on alpha, you know, 10% of the time something completely crazy happens, but of course we don't parameterize it at all. So also the suggestion of the, you know, think of the work you're doing with Florian Huber and others, you know, sort of the BART models. I think that they, because they are fully non-parametric, I agree, we're potentially offer an attractive way of approaching the sorts of problems we've got, you know, the sort of issues we are confronting, thinking about also. Well, you know, I mean, I did think earlier, you know, Martin and I thought earlier about what if we fit a kind of a kernel, just a simple kernel to our density. You know, to what degree would that offer a way of handling the outliers? And it would offer some robustness to what's happening in the tails, but of course, you still got a kind of a bandwidth smoothing parameter assumed there, which is therefore requiring you to take, you know, take some view on what's parametric, some view, not parametric then, but some view on what's happening in those tail observations. So yeah, it'd be great to talk more, think more about whether the sorts of methods you've been working on would offer a sort of a fully non-parametric and flexible way of getting at these, you know, extracting the censored shortest interval region of the density. But yeah, great question. Look forward to talking more about it.
Thank you, James. Now we have another question from Alex Gibbard. So Alex, I think you can unmute yourself.
Hi, hopefully you can hear me okay.
Yeah,
it's very interesting talk. A nice approach there with the constraints. So I was wondering, when you're doing the maximizing your censored log likelihood and you have this fixed point algorithm, how sensitive is that to the kind of initialization? Because probably that's going to be quite non-convex in terms of an optimization problem there.
Yeah, good question, and you've hit the nail on the head. You know, particularly in smaller samples, the choice of those starting values, unsurprisingly, is important. In larger samples, it's obviously, you know, it becomes less of a problem. But in smaller samples, yes, it is a problem. You know, in practice, what we often found worked well, but of course, it does really depend on the underlying nature of the data. But we often found it worked, the algorithm worked pretty well even in smaller samples if you choose the starting values for better or worse on the basis of the uncensored density, namely you do assume it goes out right into the tails and then use that as the starting values for the fixed point algorithm. But you're right, depending on, you know, obviously in the Monte Carlo we could control this, but depending on the exactly what's going on in those in those tail observations, there could be sensitivity to the starting values. And so as a result, it is important to look at whether this fixed point estimator does indeed converge on a fixed point. So I've been over this quite, I fear, rather quickly, but obviously as you iterate between those two steps, you can sort of make sure that you genuinely have reached, you know, you have genuinely converged there. So in practice, Martin and I did find it important, as I say, particularly in small samples. So I'm talking kind of observations, certainly 30, 40 observations. It became, you know, very important to look at that, you know, to look for convergence of the algorithm to make sure it had genuinely converged, or if it hasn't quite got to zero, is it kind of close enough? And that becomes regrettably, I guess, more a matter of judgment in very small samples. But once you got up to around 100, 200 observations, you know, we found the algorithm worked pretty well. But yeah, great question.
Thank you, James. So perhaps I will end the discussion with a question, my own question. So I wonder, so you estimate the density using past forecast errors. So you quantify the uncertainty using past forecast errors, but I wonder if they will make sense, or if it's possible as well to apply this model when estimating estimating a parametric model for forecasting. So also to apply this method to estimate the point forecast as well as the uncertainty attached to it. Does that make sense?
Yeah, it does, and it's nicely sort of follows on from Gary's question. also. I mean, you know, I think it would be, you know, I hope it's sort of a separate paper in a sense, but it will be a very interesting one to think about, you know, how can we produce censored density forecasts from a model, let's say, firstly, a parametric model. Gary has already entertained the possibility of using a non-parametric model, and I can see that offers advantages straight off, given that you're by definition then not parameterizing what's going on in the tails, which is exactly what you want to be doing when fitting a censored density forecast. Of course, the issue you'd have to confront, let's say, if you're fitting a VAR model, typically with a few Gaussian errors or even T errors, well, typically you assume those errors apply right out into the tails, don't you? So we'd need to think about how to estimate that VAR Gaussian errors, but only assuming Gaussianity or whatever your distributional assumption was for 90%, let's say, of the density, and you'd have to estimate your VAR on the basis of that parametric assumption. You know, sort of parametric for the central 90%, unspecified for in the tail. So interesting. That'd be an interesting problem to think more about. I certainly would need to think more about it to give you a sensible answer to what's a great question. But as Gary said, I think non-parametric models may offer a more natural way to construct a censored density forecast. Of course, I did think about, let's say you estimate your regular linear VAR model, VAR Bayesian method, you get all the MCMC draws. From the 10,000 draws, I could extract the shortest interval, any shortest interval of my choice. So in a sense, that would let me construct a censored density forecast at a censoring region of my choosing. But of course, I've made an assumption, let's say, of Gaussianity in over the full support of the density of the disturbance density in estimating that model in the first place. So I kind of shot myself in the foot in terms of the starting point of estimation of the model. So say ideally one would estimate the VAR model, whether via frequentist or Bayesian methods, but not assuming that the error is Gaussian in its across its entire support.
Okay.
Interesting thing to think about.
Thank you very much. Thank you for your talk. It was very interesting. And I would like also to remind everyone that the ESCoE conference is coming starting the 11th of May, and the registration is now open. So hopefully we will see a lot of you there. Thank you very much, James. Goodbye.
Thanks, Paul. Yeah. Bye-bye, everyone. Thank you.